Thank you very much. Well, guten Tag. Thank you very much for attending this session on fair value. We have split this session into theory and practice. I will be covering the main concepts of the standard, and in particular, I will be presenting the areas of the standard that deal with financial instruments, with the measurement of financial instruments at fair value. And Chris will go in detail into some of those concepts that we have explained in the first part of this session, and will provide you with illustrative examples so you can relate the theory with the practice. So to start with then, I will give you a brief introduction of the standard, and afterwards we will go through the measurement requirements more specifically related to financial instruments. So why was IFRS 13 needed? Before IFRS 13 was published, it was published in 2011, there were many standards that already provided guidance and that they required or permitted fair value measurements. But that guidance was dispersed and in some instances conflicted. And as a result, there was a need for a single standard that puts together into a single, in a single standard, all of the requirements together related to fair value. And as such, IFRS 13 defines fair value. Now, fair value is a concept that converges fully with US GAAP. IFRS 13 provides a framework for the measurement of fair value of assets, liabilities, and own equity instruments when those assets or liabilities are being required or permitted to be measured at fair value by other IFRSs. And IFRS 13 also enhances disclosures. So if you want to know how to measure an asset or liability at fair value, you go to IFRS 13, and IFRS 13 is the standard that answers the question of how to measure an asset or liability at fair value. But what IFRS 13 does not is it does not tell you what needs to be measured at fair value or when something needs to be measured at fair value. What and when are questions that are answered by the individual IFRSs that permit or require the fair value measurement. So this is to demystify the myth that with IFRS 13 there is going to be more fair value. Well, that's not the case, because IFRS 13 does not add more fair value measurement. IFRS 13 just clarifies and provides guidance on how to measure assets and liabilities at fair value. The objectives, the measurement objectives in the other standards are not being modified by IFRS 13. So when IFRS 13 does not apply, it does not apply to the measurement of share-based payment transactions and listed transactions. The requirements, the disclosure requirements in IFRS 13 do not apply either to plan assets measured at fair value in accordance with IAS 19, to retirement benefit plan assets in accordance with IAS 26, or to the disclosures for the recoverable amount at fair value in accordance with IAS 36. And fair value does not have to be confused with other measurements that are similar but are not fair value, such as net realizable value and value in use in IAS 36. So we have now established a bit the framework. We have said that IFRS 13 does not add additional requirements. We have also stated where does it not apply. And what we're going to go now is to the analysis of the different concepts within the definition. And we are starting with the definition that was previous to IFRS 13. That's the old definition, and you have it on the left-hand side of the screen. And it was defined as the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. And if you take a closer look to this definition, you can see that it was an exchange notion in the old definition, but the old definition did not establish whether it was an entry or an exit price. The old definition talked or referred to settlement. It didn't refer to transfer, as we will see in the new definition. And it referred to knowledgeable willing parties, so it was not clear, as it is now, that the measurement was a market-based measurement, because it did not refer to market participants, but to knowledgeable willing parties. And the definition was silent. It did not state when the measurement was taking place. So all of those uncertainties or weaknesses are improved in the new definition of fair value, which says that fair value is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So the first thing that we have is that fair value is the price that will be received to sell an asset, or the price that will be received, paid to transfer a liability. And the neutral exchange notion that we had before has disappeared, and now it is clear that it's an exit price. And it deals with an orderly transaction, so it's not a forced or a distressed sale. And this transaction happens between market participants, so it's a market-based measurement, and this measurement is taking place at the measurement date. So there is an explicit statement when the measurement is taking place. So fair value is a current measurement, reflects current conditions, and is not an entity's, is not based on the entity's expectations of future market conditions. And this is clearly stated now with the references to market participants in the definition of fair value. In many cases, or in the majority of the cases, fair value, exit price will equal transaction price. But the standard identifies 4 situations when the transaction price might differ from the exit price. And the first one is when the transaction takes place in different markets. So the transaction where we have acquired an asset is different. That market is different from the market where we're going to be exiting. We're going to be selling that asset. If we have different markets, then the entry price might be different from the exit price. Sometimes the transaction price will be different than the exit price, than fair value, when we are dealing with different units of account. So when the transaction price relates to a unit of account that is different from the unit of account that is related to the exit transaction. Transaction price will also be different from fair value when the seller is distressed or forced. In that situation, we don't have an orderly transaction, and that the price paid or the price received might not represent fair value. And of course, transactions between related parties, those prices might not be exit prices, might not be a good representation of fair value either. The standard does not deal with what do we do next. So if we do have a difference between the transaction price and fair value, how do we recognize this gain and loss? Do we have to recognize immediately a gain or a loss because of a difference between transaction price and fair value? Or do we have to defer this difference? The standard does not deal with how to account for any differences between transaction price or fair value, but it relates or it refers the accounting of such difference to the IFRSs that require or permit the fair value measurement of those assets or those liabilities. And Chris has a couple of examples where he will go through this in detail. So if we have to end up measuring an asset or a liability at fair value, what we have to build in our minds is a hypothetical transaction. If this helps because if the asset was sold or the liability transferred, we wouldn't have any asset or any liability to be measured at fair value. So the framework that you need to build in your minds is the one of a hypothetical transaction that happens between market participants, and the standard defines and describes who are those market participants. And this transaction happens in a specific market, which the standard describes as the principal market or the most advantageous market. And we are measuring an asset or a liability, and what we are measuring, when are we measuring this, is at the measurement date. So you have to build this hypothetical transaction in your mind, and you know who are the players and where this transaction is happening and when the transaction is happening, to build and to get to the measurement of fair value. Of course, the fair value framework assumes that the transaction that we are talking about is an orderly transaction. It's not a forced sale or a distressed sale. So we were saying that IFRS 13 deals with the how, and what and when were answered in other standards. And the first question that we have to answer is, what are we measuring at fair value? And this is important because the characteristics of the asset or of the liability that we are measuring at fair value needs to be considered and needs to be embedded in the measurement. And Chris will also go through an example for a financial asset, which characteristics belongs to the asset and which others do not. But the standard also tells us that we need to consider those characteristics based on the unit of account that the asset or the liability refers to. And the unit of account is being stated, or is IFRS 13 does not decide on which is the unit of account. The unit of account is given by the other IFRSs that are requiring or permitting the fair value measurement. So in the case of IFRS 9, the unit of account would be the individual financial instrument that we are measuring at fair value. So this is the what are we measuring at fair value, and this what, as I said before, is being told or is being given by other IFRSs that permit or require the measurement. Where is this transaction, this hypothetical transaction taking place? We said that it happens in a particular market, which is the principal market. And you have also on the left-hand side of the screen, you have a definition of principal market based on IFRS 13. And the standard defines principal market as the market with the greatest volume and level of activity for the asset or liability. So it's based on the activity of the asset or liability, considering the asset or liability perspective. If the conclusion is that for that particular asset or for that particular liability there is no principal market, what an entity needs to do is to look for the most advantageous market. And the standard also defines this concept, which is on the right-hand side of the screen. And the standard says that the most advantageous market is the market that maximizes the amount that we will be receiving, or it minimizes the amount that we will be paying. And to get to those proceeds that we'll be receiving or paying, we need to consider both transactions and transport costs. And we will go through those in a minute in the next slide. The standard also tells us that there is no need to undertake an exhaustive search of identifying the principal market. The standard says that in most of the cases, the market in which the entity normally enters to sell an asset or to transfer a liability, that would be, in most of the cases, the principal market already. And another feature that I would like to highlight here is that this is a hypothetical transaction. The standard does not require that the entity must have access to, does not require that the entity is able to sell the asset or to transfer the liability. Being able to sell the asset is not a requirement for that asset to be measured at fair value. What the entity only needs to have is access to that market. In fact, if the entity might not be able to sell the asset, We will have to analyze this further because that might be considered within the fair value measurement of that asset. So this is in relation to where the transaction is taking place. And as we were saying before, in order to understand and in order to identify the market that is the most advantageous market, we have to consider the proceeds that we will obtain if we sell an asset, or the proceeds that we will pay if we transfer the liability. And in getting to those proceeds, we will include both transaction costs and transport costs. However, if we are talking about fair value, we would not consider transaction costs, we would only consider transport costs. Because we were saying before that when we have to measure, for example, an asset at fair value, we would go and analyze the characteristics of that asset. And the standard considers that transport cost is a cost that relates to one of the characteristics of the asset, which is location, which is a condition of the asset. So to get to the fair value of that asset, we would consider transport costs, but we would not consider transaction costs because this is not a characteristic of the asset. We would consider transaction costs along with transport costs only when we are talking, when we are trying to identify which is the most advantageous market. And we have an exercise that deals specifically with the identification of the most advantageous market. You will see with Chris in a moment. Actually, this is an important concept because you will see that we will refer later to premiums and discounts and blockage factors. And blockage factors are prohibited in the fair value measurement. And you have to maybe refer those blockage factors. They are related to transaction costs. So this is aligned with the concept that transaction costs should not be included in the measurement, but any other premiums or discounts that are something that express a feature of the asset or liability that we are measuring, and market participants would consider them, should be included. So who are the market participants? Well, market participants was a term that was defined, so it was not a new term under US GAAP, but it is a new term under IFRSs. And the standard defines them as buyers and sellers in the principal market, and describes them as being independent. They are not related parties. They are knowledgeable because they are informed about the asset and liability and the transaction, and they are able and willing to enter into this transaction. So they are not forced or distressed parties, because if not, we wouldn't have an orderly transaction. And the assumption is that they behave rationally and that they act in their best economic interest. This is a summary of how do we get to the fair value measurement. And if we have an asset or liability for which we do have a quoted price for the identical asset or the identical liability, we would have a level 1 input, and we would use this as being the most representative price of fair value that we could have for that specific asset or liability. The standard prioritizes prioritizes the inputs based on the level of observability, and level 1 inputs are those prices that are quoted for the identical assets or liabilities. When we don't have the same level of objectivity, and it means, for example, we do have a quoted price, but it's for a similar asset, it's not an identical asset in an active market, we would drop to level 2 of the fair value hierarchy. And if we do have, for example, an input that is not observable because it's something that is coming from data prepared by the entities such as forecasts or budgets, that would be a level 3 input. So the fair value measurement will be categorized based on the relevance that all of those inputs included in the measurement play in relation to the measurement. So when we don't have a level 1 input, we still have to get to a fair value. So we have to replicate the objective of getting to an exit price. The objective of getting to a fair value has not gone away, so we still have to get to a fair value, and we will need to replicate. And then it's at that moment when we would go to valuation techniques by using a level 1, for example, input plus an adjustment, or by using discounted cash flows methods, present value techniques if we are in a level 3 hierarchy. So the objective of getting an exit price is still relevant and it still exists, but we do have to do more work, basically, because there is not a direct observable price for that asset or that liability. So that section of the standard finishes then with the main concepts, and we are starting now with the areas of the standard that deal more closely with financial instruments. And there are a few things. It's bid and ask, spreads, premiums and discounts, credit risks, and portfolios. And we will have also case studies for each of them in the second part of the presentation. So bid and ask, well, inputs might be determined on the basis of bid and ask prices. For example, dealer markets, we find in dealer markets bid and ask prices. And the question that then raises is, which price should we choose then? So within that spread. And the standard puts together a principle that is stated in the first bullet point of the slide that says, if an asset or a liability measured at fair value has a bid and an ask price, then the entity should use the price within the bid and ask that is most representative of fair value. So an entity needs to ensure that that asset or that liability is priced within a price within that spread that still represents an exit price. This principle does not preclude the use of mid-market pricing or other pricing conventions as a practical expedient. And there is a case study that Chris will go through that deals with the interaction of using this practical expedient and the principle that the standard is telling us in the first bullet point. IFRS 13 doesn't tell us what is within that spread. IAS 39 was telling us that within that spread there was only transaction costs, and IFRS 13 is not that explicit. It doesn't specify what is in there. It acknowledges that transaction costs are in there, but it does not specify what. What it does say is that credit risk is not included in the bid and ask spread. The credit risk will need to be adjusted separately. We will see this in the portfolios, the bid and ask spreads, and then the credit risk adjustments as well. Premiums and discounts. Well, as I was saying before with the transaction costs and the transport costs, the same line process, the same thought processes underlying this slide here. If the premium or discount is a feature of the transaction, for example, it is a blockage factor, it is a discount that will happen when we have a holding, and if we want to sell this holding, that sale will represent a volume that is higher from the normal trading volume of the market, and that will cause a drop. That drop, the standard does not consider that that drop is a feature of the holding, but it considers that that drop in the price is a feature, it's a transaction cost for the entity transacting in that particular market that cannot absorb that particular volume. So if it is a blockage factor, a discount that deals with transaction costs, then the standard is very explicit that blockage factors are prohibited in all levels of the fair value hierarchy. If the premium or discount is a feature of the asset or liability, and this asset and liability is consistent with a unit of account, then the standard and market participants will also embed that premium and discount into the fair value measurement. Then those premiums and discounts should be considered in the fair value measurement. For example, if an entity is measuring, well, there are a few things that we are now discussing with the board, and I will have to make a few assumptions in here. But if we are measuring the fair value of controlling interest that is unquoted, market participant might consider a control premium when measuring the fair value of that controlling interest. And then we have to go through the thought process. Control premium refers to, is a characteristic of the asset that we are measuring. Controlling interest, yes, no, yes. Other market participants would do the same, yes, no, if yes. And then we would have to go, what is the unit of account? And the unit of account would be determined by IFRS 10. And if IFRS 10 says that the unit of account is the investment as a whole, then all of those, this is the thought process that an entity will have to go through when determining whether a premium or a discount is appropriate in the fair value measurement of the asset. I'm saying that I had to make some assumptions because the board is currently discussing this topic, and we will finalize the discussions in the next quarter or so. So to summarize then, if we have a level 1 input for the asset and liability that we are measuring, then there's no need, there's prohibited basically, we don't have to adjust those level 1 inputs for premiums or discounts. We do have to adjust them if market participants would adjust them, would consider them in their measurement, and there is no level 1 input for that asset or for that liability. And that asset or that liability corresponds with the unit of account of the standard that is permitting or requiring the fair value measurement. I'm introducing here credit risk and non-credit risk before talking about portfolios. The consideration of credit risk when measuring fair value of a financial instrument is not something new in IFRS 13. IAS 39 included guidance on fair value, and it also already stated that fair value reflected the credit quality of the instrument, and the publication of IFRS 9 did not change this either. What happened is that there was inconsistent application on the requirements relating to own credit risk. Some entities took this into account, some other entities did not. And we learned of a survey performed by one of the big audit firms. And in that survey, they included 16 financial institutions back in 2010. Almost all of those entities recorded credit valuation adjustments on derivative assets, and they also recorded own credit risk on liabilities measured under the fair value option, but only 6 out of 16 recorded the own credit risk for derivative liabilities, which is also known as debit valuation adjustment. So only 6 out of 16 back in 2010. The main argument used not to consider the own credit risk for derivative liabilities was that IAS 39 was not explicit in requiring an adjustment on derivative liabilities. IFRS 13 comes along in 2011 and is published in 2011, and it clarifies that fair value of a liability includes an entity's own credit risk. And in 2012, the same survey was done, and this big accounting firm surveyed 19 financial institutions, and those institutions, all of them, recorded credit valuation adjustments on derivative assets. All of them recorded own credit risk on financial liabilities measured under the fair value option, and the ratio of entities that recorded the debit valuation adjustment on derivative liabilities increased, and 13 out of 19 were recording in 2012 the debit valuation adjustment, when the standard was not still effective, but it had been published. One of the reasons why entities were not maybe recording debit valuation adjustments is because the old definition of fair value included settlement instead of transfer. And the concept of settlement, some constituents did not believe that a debit valuation adjustment was, should be reflected in the price to settle a derivative liability. as I was saying before, IFRS 13 replaces the term settlement for the transfer concept, and the change was done because, according to the board, a transfer concept, a transfer notion captures market participants' expectations about the liquidity and about the uncertainty and other factors of the liability better than settlement. The board thought that settlement could include entity-specific attributes. And also, IFRS 13 introduces the concept of symmetry. So when we have to measure the fair value of a liability, if an entity sees that there is no transfer price for the exact liability, an entity might consider a market participant holding that liability as an asset to get to the fair value of that liability. So the path, the thought process in here would be, we have to measure the liability at fair value. Is there a transfer price available for that liability? That's unusual and that's difficult to get. So the second step would be, is there a market participant out there that holds this liability as an asset? And if so, I will consider that as a premise for the measurement of the liability. And because the financial asset would include a credit valuation adjustment, then the opposite thought process is made to include a debit valuation adjustment when we're talking about financial liabilities. This slide just gives you the definition of credit risk. This definition comes from IFRS 7 and is the risk that one party to a financial instrument will cause a financial loss to the other party. And it also states own credit risk. Own credit risk is not a term that is defined in IFRS 13. Own credit risk is a component of non-performance risk. Non-performance risk is defined in IFRS 13 as the risk that an entity will not fulfill an obligation. And one point to mention about own credit risk is that own credit risk relates to the financial instrument that we are measuring at fair value. It relates to the financial liability that we are measuring. It does not only relate to the issuer. So the credit risk of the issuer is an important component of the credit risk of that liability, but not the only one. The features of that liability might also need to be considered because they also count on the credit risk of the liability. Own credit risk relates to the instrument, not only to the issuer. That's the main idea here. And portfolios is the last section on financial instruments. It's presented in the standard as an exception, measurement exception. And the word exception comes from the fact that the objective of fair value is to measure the fair value of an asset or the fair value of a liability. And in that case, what we are doing, or the aim of the portfolio exception, is to get to a price of an entity's exposure, net exposure to a particular risk. So what we are measuring when using the portfolio exception, what we are pricing is a risk for a particular market, or for a particular market risk, or a credit risk. We are not measuring per se a financial asset or a financial liability. But of course, once we have this risk priced, we will have to allocate this risk, this price, to the individual financial instruments that are comprised within the portfolio. So basically the standard is a permission, it's an option. Permit is not a requirement, so it's an accounting policy choice. And basically what the standard says is, if an entity manages a group of financial assets or financial liabilities on the basis of the net exposure to market risk or to credit risk, the entity is permitted to measure that net risk exposure. Once this net risk exposure is measured, then the entity will have to allocate back to the individual financial instruments within that portfolio that risk. This exception is not affecting the presentation if other standards allow for gross presentation, so require gross presentation. And there are some conditions that an entity needs to fulfill, that those portfolios need to fulfill in order to be able to use the portfolio exception. Of course, if we have a portfolio of financial assets and financial liabilities and we are trying to offset market risks, those market risks needs to be substantially the same, and the duration of those instruments needs to be also substantially the same. And what we are trying to do then is the portion of the market risk that is not offset, we will need to price that portion, and we will price that portion based on the bid and ask spread, considering whether we have an asset position or a liability position in a particular market risk. And we will do a similar exercise for credit risk. If an entity has a master netting agreement with the counterparty that might mitigate the credit risk exposure, might consider then to price the credit risk that has not been offset, considering whether the exposure is an asset or is a liability. With this, the financial instrument section is finished. Only a few notes for you to consider, because there is some case examples that we have prepared that deals with fair value when the activity of the market has decreased and dropped, and we thought that it was going to be useful to have those considerations before going straight to the exercises. So IFRS 13 includes guidance to how to measure fair value when the volume or the level of activity has significantly decreased. The volume or level of activity of an asset or a liability that we are measuring at fair value in a specific market. And before IFRS 13, the IASB published a report that is in the website. It's called Expert Advisory Panel Report. And basically the IASB put together a working group based on recommendations of the G20, the Financial Stability Board, and the IASB and the FASB's Financial Crisis Advisory Group. And that report put together guidance on the measurement and disclosures of financial instruments when markets were no longer active. And the guidance provided in IFRS 13 is aligned to that guidance in that report. The report was published in October 2008 as a result of the financial crisis. And fair value is a measurement that reflects current market conditions, and of course when there is a decrease in the level of activity, further work needs to be done. This is an area that is highly judgmental. There is no bright lines in the standard, and there are not specific requirements or specific thresholds that will trigger immediately that a market is considered, for example, not active. So there are not explicit answers to many of the questions that you might have, because it requires a thorough understanding of the facts and circumstances surrounding the financial instruments, surrounding the market, and maybe you can be a bit disappointing with when reading this section of the standard. Basically, the standard provides guidance on how to assess whether a market is not active, and the standard also provides guidance to assess whether a transaction is orderly or not. And to assess whether a market is not active, the standard provides some indicators. And of course, you will see they make common sense if you read them through. So when we have fewer recent transactions, when the bid and ask spread widens, when there is very little public information available, when the market does not have new issues, all of those are indicators that the market is no longer active. But the standard emphasizes that even though the market has dropped, has decreased its volume of and level of activity, that doesn't mean that all of the transactions that we observe in that market are not orderly. So the standard still makes clear that an entity needs to make a second assessment, and the second assessment is whether the transaction is orderly or not. And again, the standard provides some indicators for you to go through, for an entity to go through, to determine whether a transaction is orderly or not. And if there is evidence that the seller is stressed, in near bankruptcy, for example, or if there is evidence that the seller was required to sell to meet regulatory or legal requirements, when the transaction price is an outlier, when compared with other recent transactions, all of those are indicators that the transaction that we are considering, the price of that transaction is not a good representation of fair value, is not a good representation of an exit price, basically. And before the measurement date, the transaction has had to go through marketing activities that are normal marketing activities for the sale of the asset or for the transfer of the liability. It doesn't have to be a forced sale or a distressed sale. It has had to go through the customary marketing activities. So the transaction has had to have an exposure to the market before the transaction takes place. Yes, well.
Portion of the equity of that company on the market.
It is to distinguish a sale being a forced sale, which is the seller is distressed and needs to sell the asset, or whether the transaction is, or it belongs to the definition of orderly transaction. And an orderly transaction is we are not selling right away because we are forced or we are required, but all of the activities that an entity needs to go through for the sale of the asset has happened in the normal way. Yeah.
One additional question. So,
yep.
Forced sale is related to the seller. The seller
is forced, yeah.
The seller is having the trouble.
Yeah.
So, this is in bankruptcy or wherever, and then we consider that that is not an orderly transaction.
Exactly.
But what we saw during the crisis was that it was not the seller, it was the market that was in a strange situation. So, would that be...
It's the first consideration. So the activity in the market needs to be assessed. An entity needs to assess whether the volume of the market has significantly decreased and whether the transactions and the prices of those transactions are orderly or not. If the entity assumes or concludes, that are not orderly, then more work needs to be done because the fair value objective is still there. We still need to get to an exit price, but we might need to go to do some valuation techniques. So the first assessment is, is the market active, yes or not? And if we conclude that it's not, then we need to still assess whether the transactions are orderly transactions or not. Because those transactions, even though the market has decreased, those transactions still may represent fair value in that current condition. But if it is not, then we have to do more work because we still need a price, but we cannot get it.
That was my second question.
Okay.
Once you know that the transaction in the market is not a reliable one in order to get the information you need, what is the next step? And I understand...
Yes, you need to perform a valuation technique. The standard doesn't tell you you ignore the transaction price immediately. It might still, you give less weight to that price, but you still need to consider it as a starting point for the evaluation because, but you might need to do further work and you might need to adjust basically that price. If you can back it up and you can support, I mean, the standard doesn't say in which direction the new price will go. We are considering that price.
What we said during the crisis, we said those transactions are not ordinary.
Yeah.
So you can return them at prices, I don't know which they are.
You would have to back up as well the prices that you get with some valuation techniques that are robust and that reflect. So we don't have to go away and reflect a world where we are not. So the current market conditions need to still be reflected in the measurement.
Just a quick question and clarification. You are at measurement date. At measurement date, you have certain conditions, right?
Yeah.
3 days after the price goes up, you don't consider the 3 days the price 3 days after.
No, the measurement date is.
It can be a confirmation, but you don't use that. You have
Yeah.
to be at measurement date.
Yeah.
So you don't take the future price.
No.
Right.
Well.
But I guess I'd qualify that bit. I guess it depends on the circumstances. Because
Yeah.
if we were talking about, for example, quoted equities, then yeah, you could just use the price at measurement date. If we were talking about one of these difficult situations where there was very little market liquidity in a particular security or other single securities, then you could maybe, in terms of searching around for evidence, maybe you would look at some prices just after the measurement date to try and get some evidence around what a hypothetical transaction price would have been.
I agree with that. The issue might be that in some of the markets, in smaller markets, there's no transaction per day, and in trying to find some transaction, it's very confusing that 3 days after a transaction that is made at a very high price, and then it can be trouble because there's all kind of manipulation possible. So I think that's what I'm getting at. You have some markets that are not perfect, and certainly in smaller markets, not every market is England, Frankfurt, London, Paris, New York. There's not some big transaction every day.
As I
The question really is so I don't have a price on the 31st of December.
Yeah.
I still cannot use the price of January, because then why I wouldn't use the price of the 10th and the 15th, and and have your interpretation. You have to go back to the measurement date and try to make an assessment.
can I just
What I understand.
say
I'm closer to think this is the way you would do it. Of course, when you are measuring something, you are not ignoring things that might have happened 2 hours later. So that might influence maybe your measurement, but that would not be the starting point of your measurement.
But as I see it, and you also said it, you still didn't, for example, as we supervisors would like to have this definition, what is an active market.
An active market, there is a definition in the standard.
Yeah, few transactions, few recent transactions. If you were a lawyer, that would be few transactions, 3 transactions in last 3 months, last 6 months.
It is a highly judgmental area, and the standard cannot tell anybody when exactly a market can be considered inactive or not, because it will depend on the financial instrument that we are measuring. It will depend on the jurisdiction and in the market that we are measuring. So who is the standard setter to tell the market when the market is active or not? I think the standard is providing some guidance, and that's probably the maximum that we can do.
Well, I think that there is a definition of the standard, and the definition of the standard ties into the objective of the standard, because it says an active market is one which provides pricing on an ongoing basis. So it's telling you can just look at the market price and that's fair value. And you don't have to get into these more difficult issues because there's a constant flow of trade of reliable pricing information. If there isn't a constant flow of reliable pricing information, why would you specify you must use that price in all circumstances? Because it hasn't met that threshold of almost prima facie automatic reliability. You know, if I had a choice between using a a price that was, in terms of my starting point for measuring fair value in a particular instrument, had a choice between a price that was 2 months out of date and a price that was 48 hours after the measurement date, I think I'd start with 48 hours after the measurement date and roll it backwards, not just look at some price that was 2 months out of date. And if you said to them something like, well, it means 3 trades per quarter, basically you're baking out date pricing.
Just to make sure that I understand the dynamic of this issue, I'm not judging if I like it or not.
Yeah.
I just want to understand. So we see that there is a price in a market,
Yeah.
and that market starts to behave in a
Yeah.
disorderly manner.
Yeah.
And then we say, well, those prices, that information is no longer reliable, so let's look for something else and do some valuation. Basically that.
Well, the threshold is the volume, is the market active or not?
But imagine that
If it's not, that might not mean necessarily directly that this transaction is not orderly. So there are two thresholds probably of assessment, 2 assessments. The first one is the market active or not? If it's not, it might not mean that all the transactions are not orderly. So we will have then the second assessment, is that transaction orderly, yes or not? And then from there, then we will have to do valuation techniques or not.
Based on, to the extent possible, in observable inputs.
Yes, if it's orderly, then
No,
we will
meaning-
give higher weight to that price because it's an orderly transaction.
I'm asking because at the beginning of the crisis, when the problems with these mortgage-related assets, what happened was that these assets that were never highly liquid or whatever, but no one questioned the prices that were reflected in the balance sheet of these entities. Once these markets started to have trouble, then those prices started to be questioned.
Yeah.
And then what the auditors did was, in any case, we need a fair value here, so look for whatever you think it could be a reliable indication of the price. And they went and found this ABX index that was very thin traded, and many questioned the information that was embedded in those transactions. But in any case, I remember that the profession, the auditing profession, issued some guidance saying, use whatever you find, and if the only thing that you find is these transactions, use it. And that meant massive write-downs for these institutions, which probably was the right thing. But I'm just trying to see if, with the new standard, we are addressing this situation in which, in the end, it was a very, very small transaction that meant massive write-downs.
Well, the standard is providing guidance on how to assess whether those transactions are orderly or not. And in that case that you explained, the assessment might have been that those transactions were orderly when they weren't. And maybe an entity would have to go back to evaluation technique. So the standard will not address or will not improve how entities will conclude or on the assessment process that entities will do. The quality of those assessment processes will depend on the entities. The standard is providing some guidance on how to identify whether those transactions are orderly or not, nothing else than that.
In terms of rolling it back to 2009, obviously this standard, Mariela mentioned the IASB Expert Advisory Panel report.
Yeah.
Actually, what's in IFRS 13 is not really taken from that report. What it's taken from is the guidance that FASB put out in 2009, which had a certain degree of similarity with the IASB Expert Advisory Panel report, but basically it's a sort of updating of the US GAAP guidance that FASB came out with during the crisis. And essentially the same guidance. And I think the only really significant difference when you work through it from the IASB Expert Advisory Panel report, the IASB Expert Advisory Panel report said either you had orderly transactions and transactions that are orderly and you take them into account, and you have transactions that you know are not orderly and you ignore them. And what the this guidance does. It sort of says, well, you've got to look at the transactions, and maybe in many cases you don't know whether the transactions are orderly or not orderly. It's very hard to work out. And in those cases you place some weight on them, but less weight on those transactions and the things that you know to be orderly. So I don't think this guidance really gets you somewhere different from where essentially a consensus built up during 2009 in terms of what to do in those very different circumstances.
Right, so the standard is effective from January this year, and earlier application is permitted. Sorry. Oh. Okay.
Yeah, concerning the principal market that you mentioned before, suppose that as far as I remember, the principal market was with the largest volumes, right?
Would it be possible to wait for Chris to go through this case, because he will go through an example dealing with the principal market and the most advantageous market, and if with that case the question remains, then you is that okay?
Yes.
Because then we will give an opportunity to the case studies to start as well. Thank you. So basically the earlier application is permitted, and the transition provisions are prospective, so we don't adjust the comparatives. And with that, then we start with the case studies, and Chris will go through. All right.
When annual statements are audited, like bank statements, so if so it's end of year, but if it is done in March, April, May. So if, let's say, adverse information is available in February, March, should it be reflected in the previous end-of-year statements, like on loan book or other?
On the measurement date, the measurement is done in December. It will have to be probably disclosed. I mean, disclosures are, nobody prevents an entity to disclose things that might have happened, but the measurement at that date would not have included those facts that developed later. Or if, I don't know, with hindsight we can say, well, those factors were already there and nobody realized.
At least what I know in practice, the auditors, they require the latest information. So if they are auditing in March, so they would require it.
It is an interpretative area, this one, because at which extent do we know this information was already there and was not used?
I think there's two aspects of that. There's the disclosure aspect. Of course, it should be disclosed that there has been an adverse event that has particularly impacted the value, but it doesn't influence the measurement, so it doesn't influence the bottom line.
Yeah.
I think one of the infamous case was the Isern case, where something happened after the end of the year and impacted the result of the year. I think there's many people who were not very happy with that.
Yeah, that was a very unusual accounting.
Okay, Mariela, thank you very much.
Thank you.
It was